Liberation Day is an apt name for Donald Trump's policy to impose massive new tariffs across the world.
President Trump's tariffs are continuing to send shockwaves and fuel fears.
Everything, everywhere, all at once.
Hey guys, what's up? I'm Erin and welcome back to the channel. The markets just got rattled, big time. A 25% tariff was announced on autos and parts by President Donald Trump, and it sent shockwaves through the market. There was a 1,600 point drop just with the Dow. But that's just one piece of the puzzle. The S&P 500 is down 13.7% year to date. The Dow has dropped nearly 5,000 points. And the Nasdaq, it's taken the biggest hit, down just over 19% year to date. With trade tensions heating up between the US and China, concerns about stagflation, that painful mix of high inflation and slow growth, it's creeping back into focus. So the question now becomes, is this another blip, or is this a sign of something long-term and more serious? Tariffs are essentially taxes on trade, and they tend to ripple through the economy in several damaging ways. First and foremost, higher prices. Tariffs on autos and parts raise the cost for businesses, and those costs often get passed on to consumers. Purchasing prices rise, which adds to inflation. Then we have supply chain disruptions. Many US manufacturers rely on global supply chains, and when we have disruptions to this system, it reduces efficiency, increased costs, and causes delays. It also causes reduced consumer spending. As prices climb, consumers' purchasing power shrinks, and people pull back on spending, which slows overall economic growth. And all of this causes corporate uncertainty. When policy changes are unpredictable, companies tend to pause on hiring. They delay investments. In general, they just pull back. And this weighs heavily on the job market and overall GDP. Because markets hate uncertainty. And a surprise tariff on a major industry like autos sends a signal that trade tensions are escalating and they could be heading for a full-blown trade war. And that introduces several headwinds. Inflation increases as imported goods get more expensive. Economic growth slows as global trade contracts. And corporate earnings take a hit as companies adjust to higher costs and rising risks. It's a really tough combination that has very real concerns that we might be headed for a situation of stagflation, a situation where prices are increasing, but the economy is sort of stalling. And this is a very difficult position to be in because we're kind of limited in what policymakers can do to combat it. In a typical situation, the Federal Reserve has a clear playbook. If inflation is too high, they raise interest rates to cool things off. If the economy is weak, they cut rates to stimulate growth. With stagflation, these strategies kind of clash. If you raise interest rates, you risk slowing the economy even more. But if you reduce interest rates, you risk making inflation worse. It's really a no-win situation. It's kind of like driving while having your foot on the gas and your foot on the brake. No matter what you do, you're fighting yourself. And as you can imagine, many investors are feeling uneasy with the way the markets look right now. To get a better sense of what's happening, let's use the year-to-date performance as of April 4th of 2025 and use 3 different portfolios to see what's been happening. Let's take a look at how different portfolio strategies have held up so far this year, starting with an initial investment of $500,000. Portfolio 1 is fully invested in equities, 80% in the S&P 500 and 20% in Vanguard's International Index Fund. Year to date, this portfolio would be down 11.6%, bringing its value to $442,000. Portfolio 2, this introduces some protection, with 60% in the S&P 500, 20% in international, and 20% in bonds or cash-like equivalents, earning around 4.5%. This mix would have resulted in a smaller loss of 8.55%, leaving the portfolio at $457,000. And Portfolio 3, this leans more conservative, with 50% in the S&P 500, 10% in international, and 40% in bonds or cash-like equivalents. That approach would have limited losses to just 6.7% for a final portfolio value of $466,500. It's important to remember diversification isn't about chasing the highest returns. It's about managing your risk and protecting your portfolio for those times when the market gets a little rocky. Sure, a concentrated portfolio might outperform in the good times, but when we have the turbulent times like we're seeing now, a more diversified portfolio tends to smooth out the ride. It really cushions the blow by having a mix of assets that don't all move in the same direction at the same time. So while you may not get absolute peak gains, it helps brunt the full blow when the market takes a hit. And if it keeps you invested for the long term, well, then it's well worth it. There is no one-size-fits-all portfolio. What works for one investor might not work for another investor. It really depends on your time horizon and your comfort with risk. If you're 30 years away from retirement, sure, you may be comfortable with a portfolio that is 100% in equities. It may be more volatile in the short term, but if you're not planning on touching these funds, you can just ride it out. You have time on your side. You can have greater upswings and greater downswings so long as you're not relying on this portfolio right now. But if you're at or near retirement, the picture changes. At that point, preserving what you've built becomes just as important as growing it. At that point, you might want to shift towards a portfolio that's a bit more conservative, one that kind of smooths out the bumps so you don't have as big of swings, especially if you're in a position where you're drawing an income from this portfolio. The bottom line is your portfolio should evolve with you. What's the right portfolio for you today might not be the same portfolio 5 or 10 years from now, and that is perfectly okay. We've actually faced stagflation before. One of the most well-known examples of stagflation in the US history came in the 1970s, where the stock market looked almost flat for nearly a decade. This was referred to as the lost decade for stocks, and the Dow Jones stuck between 800 and 1,000 for most of the decade. And when you adjust for inflation, the story gets even worse. Real returns were actually negative. So even though you weren't seeing these huge drops on paper, your purchasing power was shrinking. Then came the crash of 73 and 74. The market dropped by 45%. We were in the middle of an oil crisis. There was rising unemployment and inflation was soaring. These are all kind of classic symptoms of stagflation. So what turned it around? Well, it wasn't quick and it wasn't painless. The 80s began with even more economic stress, but slowly some economic policies started to make a difference. The Federal Reserve aggressively raised interest rates to fight inflation. This caused a recession, but ultimately it worked. Then came Reaganomics, a mix of tax cuts, deregulation, and increased government spending, all aimed at restoring business confidence. As inflation cooled and interest rates began to fall, the stock market finally had room to grow. The result was a bull market that hit in the mid-80s. By 1982, the Dow surged past 1,000, finally, after a decade of fumbling around that number. By 1987, it was at 2,700, tripling in just 5 years' time. Yeah, we did hit a speed bump with Black Monday in 1987, where we had the biggest single-day drop in market history up until that time, but the economy held firm and the market quickly rebounded. So what did stagflation look like for long-term investors? Let's say you had a 100% equities portfolio and had $10,000 invested at the start of 1970. By 1982, if you reinvested your dividends, your portfolio would have grown to about $32,000. That's a 219% return over a 12-year period. But what about without reinvesting dividends? Your portfolio would have been worth just under $17,000. Still a gain, but much smaller. Now, here's where things get interesting. What if you adjust for inflation? The numbers tell a different story. With dividend reinvestment, your portfolio's inflation-adjusted value in 1982 would have been just under $13,000, giving you a real rate of return of 28%. Without reinvesting dividends, your real rate of return would have actually been negative, down 32%. Periods of stagflation are tough. There is no question about that. But history shows us that they don't last forever. And the strategies you use, like staying invested for the long term, making sure to reinvest your dividends, and having a diversified portfolio can really make or break your long-term success. So how do we deal with stagflation if it happens? If stagflation returns, we're going to be working to manage a very tough economic situation. Why? Because fixing one problem tends to make another problem worse. That's why policymakers usually focus on taming inflation first, even if it means short-term pain, like higher unemployment or a recession. That's exactly what happened in the early 80s. The Fed aggressively raised interest rates to get inflation under control. It worked, but it wasn't painless. In some cases, the government can turn to the supply side of things by increasing production or easing regulation. This can take the pressure off prices without overheating demand too much. The truth is, there is no quick fix. But with the right policies in place, economies do recover. And history shows us that for long-term investors, they tend to come out stronger on the other side. And with all of this uncertainty, it's natural to feel uneasy. But here's the most important thing. Don't panic. Stay informed and focus on the long term. Markets can be incredibly emotional in the short run, but focusing on the fundamentals like inflation, unemployment, and GDP, these are really the items that drive market performance. So focus on the real numbers rather than just the headlines. Next, take a look at your portfolio diversification. Certain sectors like autos, manufacturing, and tech might be hit harder during times of tension and trade, so a best bet might be to spread out your investments across multiple sectors. You might consider defensive sectors like healthcare, utilities, and consumer staples, or international exposure to reduce the reliance on just the US market. You could also look at dividend-paying stocks, which provide a steady income, and inflation-protected securities. Also, take the time to evaluate the businesses you're invested in. Look for companies with strong balance sheets, pricing power, and less dependence on global supply chains. Those tend to hold up better in uncertain markets. And finally, check on your risk tolerance. If this year's volatility has made you uncomfortable, it might be a sign that you need to rebalance. You need a portfolio that aligns with your comfort level today, as well as your long-term goals. At the end of the day, the markets will always move up and down. So your strategy, your discipline, and your time in the market, that's what matters most. You need to focus on it as a long-term gain. Stay invested for the long term. Let me know your thoughts on what you see in the economy these days. Share them in a comment down below. I'm always curious as to what you have to say. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. First video done. There's a train going by and I don't know if you can hear it because this is day one of filming here. And, I decided to live next to a train station. Probably not the best judgment call, but I think we'll be okay. I'm gonna get sound panels, redecorate the background, so we're working on it. Your time horizon and your comfort level. Okay, no, absolutely not. Rising unemployment and soaring on inflation, that's not a word. New location, same errand. And the stock market quickly rebounded. I messed up that last round, did you hear it? I'm so mad at myself. Please tell me if you can hear that train, okay? I need to know if I can film through it or if I have to wait for it every time it happens. Hopefully you can't hear it, but I don't know yet since first time, so I'll just wait it out this one, but let me know. Give me your feedback, please.